On the podcast with us today is Anna Kelly. Anna, welcome to the podcast.
Thank you so much, Dan. I'm glad to be here.
Well, Anna, I know we're going to be looking forward to right now diving into this Brownstone Manor apartment. There's a lot of unique things with this property, 73 units, apartment units, 44 storage units, and it's located in Pennsylvania, correct?
It is. It's in a town called Hummelstown, which is right outside of Hershey, Pennsylvania.
Okay. And so before we dive into this property, I want you to give the listeners a little bit more detail about you and your background as it relates to multifamily.
Sure. So I've been investing in real estate off and on for about 20 years. And about 5 years ago, I decided I have a financial advisor background and I work in the corporate world for a large insurance company. And I decided I had 4 children and I wanted to work myself out of my corporate job, retire from my 6-figure job. And so I decided to start buying real estate, passive rental real estate, in order to replace my income. So in the last 5 years, I've really aggressively bought part-time while working and raising my kids, mostly small multifamily buildings. So I have a lot of 4-unit buildings. I've bought and sold a few in the last couple of years, but right now I have 60 units that I owned before I went after the larger multifamily deal. So I had thought about buying larger multifamily deals before, but I really didn't have the time to start networking and building partnerships and syndicating, and had read a lot of books about it and thought about it. But I just got to the point last year where I really replaced my income passively, and I've got a plan to retire this year in a couple months. And I said, okay, now is the time for me to really delve in and start working with partners and starting to go after larger multifamily deals. So this is my first larger than 4-unit buildings. I have a couple small commercial mixed use things, but my first larger multifamily project.
And are the other properties that you have, are they located near you or are they in other states or?
I have 2 vacation rentals that are in Ocean City, Maryland, that are nice high-end vacation homes. Everything else that I have is here pretty much right outside of Hershey, Pennsylvania, where this complex is, where I can kind of self-manage them. So I do self-manage 58 of my units and the other 2 are away.
So how do you self-manage them if you're also working at the same time, or have you now stopped working?
I haven't stopped working. I'm planning to retire very soon, maybe sooner if my employer starts seeing me on these podcasts, but in the next few months. My husband is a chiropractor and he has his office open 3 days a week. And so the other 2 days a week, he basically, if we get a call that there's something minor happening, he'll go check it out. But when we bought our buildings, we completely renovated them. So there's very little that goes wrong that's big. We're in an area that has a lack of supply and a lot of demand. So I have very low vacancies, strong blue collar and white collar, average income area. And so it's pretty easy to self-manage the types of properties that I have, and really doesn't require a significant amount of time now that we've completely renovated them. Mm-hmm. But basically lunches, some evenings we've self-managed, and we've tried some different property management options, but being in a small town, there aren't very many. Mm-hmm. So right now my husband does, the basic stuff. And then we use trades, professional plumbers, electricians, roofers for anything that we need that goes wrong.
Mm-hmm. Okay. Well, good. Well, that's kind of neat to be able to have somebody else helping you alongside of you as well. And kind of, doing that property management and saving that expense on these assets as well.
Right. But I definitely like larger assets and having on-site property management. It's a game changer. So mm-hmm. It's definitely what I'd like to continue to focus on.
Yeah, for sure. So what did you purchase this Brownstone Manor apartment for? What was the purchase price on it?
So we landed ultimately at $6.2 million, and it took some negotiating and back and forth to get there, but that was our final price.
Okay. And what kind of asset class is the property, and then also the area?
I'd say the area is an A- to B+ area. And other than the fact that the property was built in the 80s, the exterior was completely renovated and updated in the last 3 years. So there was really no deferred maintenance and nothing to do. So I'd say the building is a B asset.
Okay. And how did you find this particular project?
So this project really came to me just through putting out there what I wanted to do. I had an acquaintance relationship with a seller I did not know that he owned apartments, and he heard me dealing with tenants and asked me if I was still, working and how many tenants I had. And I said, yes, I am. And I have a lot, but I'm about to go after larger complexes so that I can hire a full-time property manager on site and make my life a little bit easier. And he said, Anna, I'm selling a building next week. I said, no, what do you have? Tell me about it. So he had it. He had already gone to one of the large brokers. He already had the marketing package. He had the listing agreement. He just hadn't signed it yet. So I said, can I see it tomorrow? And he let me see it and gave me an opportunity to make him an offer that we could be comfortable with before he listed it. So I felt very blessed to have bumped into him at the right time.
So what was the setting like where he overheard you? Was it like at a networking meeting, or how did he overhear you talking about it?
I was at gymnastics. I have a little girl that's 7, and she does competitive gymnastics, and he was picking up his granddaughter, who he never picks up there. And we just happened to run into each other. So I was on the phone dealing with the tenant issue, and he's like, oh, I've been there. I've had tenants. And we just started getting to talking, and he's like, I can't wait to sell. I said, well, let's talk.
Well, that's definitely a motivated seller when they're, ready to sell, for sure.
It is. And it's exciting because I had already been looking for a larger multifamily property. I had already been talking to my partners about going after things, and we had been evaluating things in Pennsylvania and in Texas and some other states in the Southeast, like a lot of other people. And we just didn't find anything that really, compared to the types of returns we could make on the smaller stuff that we own, really just didn't find anything sexy enough for us to go for it. So this deal really did fall in our lap, not that we weren't actively looking and trying to do something on other deals at the same time.
So you agreed on the $6.2 million after going back and forth, and we'll dive into some more of the due diligence stuff here in a few minutes. But on this particular offer, you weren't competing with anybody else, so you didn't have to worry about that, right?
I didn't, except he was very serious about selling. And because he had already had the marketing package, they told him that he should get somewhere between $6.7 and $6.9 million for the property. And of course, that included a realtor broker commission. But based on the asset, how nice it is, how limited supply there is, and how much demand there is where we are, he knew he would get into a bidding war. And one of the things that, because he knew of me, we have a lot of similar acquaintances. He knew what I did. It just gave him a level of trust that he was willing to talk to me. Mm-hmm. And he had some things that were really important to him, such as how his property manager was treated and whether his property manager got to stay. And that ended up being a motivating factor for him working with us rather than listing it with a broker, waiting for the right buyer, and knowing that his PM that he really cared about would probably be cut.
Mm-hmm. Did you have to put any earnest money up on this one once the offer was accepted?
Not a penny.
Wow.
I was really surprised.
That's definitely a lot of trust from a seller, especially since he knows you. That definitely went very well for you.
It did. And, he's very smart. He's a money manager. He's a wealth manager. He's an attorney. But he basically trusted me, and he knew that he had nothing to lose. And we basically sat down and said, listen, if we can make it work and it's going to be a win-win, let's do it. And if not, there's no hard feelings. You'll list it and you'll get what you want for it. But so there was a lot of back and forth negotiation, but I literally met him at his dinner table, and we sat down and talked several times until we got the deal done.
So did you already, when he told you about this property, had you already known a little bit about the property beforehand? Had you already, known where it was located and stuff like that? Or had you still never seen it before? And at what point did you actually tour it?
Well, I had seen it, but I didn't know that he owned it. And okay. So when I ran into him, he said, I'm listing it next week. I said, where is it? He told me, and I was familiar with the complex. So he was about to leave town two days later. And I asked, can I see it, tomorrow? And he agreed. So I took a vacation day and I went and looked at the property. He got me into 6 of the units, and he sat me down with the property manager and said, open the books and let me, look and print out 3 years of P&Ls straight from his QuickBooks. So pretty much the very first day I had all the numbers I needed. I had walked at least one of each unit type and seen the property. So I had an upper hand in that I probably wouldn't have gotten in a lot of other deals that made my due diligence nicer.
Mm-hmm. So let's talk about the due diligence a little bit here. At what point were you able to start that due diligence? Now, obviously, you saw a little bit of it even before you made your final offer. You had your final agreement in place, but you came and toured the property. You did a little bit of due diligence from that standpoint. But at what point did you start the full-on due diligence, and how much time did you have to be able to do that according to the contract?
Sure. So he was leaving town for a week on vacation, and so he gave me the numbers. And actually, he had given me the first year of P&Ls that first day. And he had a delayed vacation because of a hurricane that was coming. So I knew he was in town for one extra day. And he said, if you want to do something, I need to know pretty much today before I leave, because I'm supposed to sign this listing agreement. So I said, let's get together and at least talk. So I used the first year of P&Ls to make him an offer. And when I sat down with him and made him my initial ballpark, what I thought it was worth, we were pretty far off. We were $900,000 off of, at the time he wanted $6.7 million. And so, he had given me at that point the marketing package showing me what the broker thought it was worth and what it would sell for, gave me a little bit more information about the property. And then at that point told me while he was gone, I could go in and pull all the rest of the P&L and the detailed accounting from QuickBooks. So while he was out of town, we had not had an offer at that point, but while he was out of town, I really delved into the numbers, very deeply and did my underwriting. And that way, when he got back in town, I was able to say, okay, here's what we're willing to pay.
Mm-hmm. And during the due diligence process, did anything come up that you had to maybe go back and renegotiate the amount that you had originally agreed upon or anything like that?
We did. We had some interesting, very small hiccups, but hiccups nonetheless. So the marketing package, he told me, it's 74 units and we have this house. And the house was basically on the main property, but they had purchased it after they had built the land. So they had one big, you pull in and there's the house where the property manager lives and then the rest of the complex. And what we found out walking the units with our lender, a couple of weeks later, was there actually was one less unit. The 74 included the house, so it wasn't 74 plus the house. So that changed the amount of money we thought we could get in rents and what we thought the property was worth. So that was an issue. Other than that, there were no big surprises, nothing really that stood out to us. Like I said, the exterior had been very well maintained and a lot of things had been redone. The interior units, some of them were obviously not as in good condition as we would have liked the others. But because we had his actual financials, there wasn't anything, like you typically see when you have an offering memorandum that may estimate numbers, and it turns out that that's not what it is. Like, we knew the numbers really well going in. So that one less unit was really the only thing that stood out at us as an issue.
What's the vintage of this property?
He built the complex, he and his father, in about 1985 to 1986.
Okay, so it was a one-owner project.
It was. Now, they had bought the land from, I'm not 100% sure, but I believe it was the people that owned the complex next door. Same builder as the complex next door. So our units are the same. They look very similar. There were 8 duplexes in 4 buildings and 3 units in a triplex building that were already there that were built in the 70s. And so he kept those on the property, and then he built the rest of the units.
Okay. And then you also have 44 storage units on there as well, correct?
Right. And they built the 44 storage units there as well.
Okay. So basically the apartments that they built, which was those, I'm just doing the math here, those 62 units plus the 44 storage units were built around 1985.
Right. Somewhere in that range.
Okay. All right. And how did you end up financing this deal?
So we contacted a couple of brokers and ended up going with CBRE. And CBRE is a direct lender with both Freddie and Fannie. Mm-hmm. And so they basically took our underwriting, they did their underwriting, and there were a few exceptions they had to ask for in order to make the deal work. But we ended up going Freddie Mac small balance.
Okay. What kind of interest did you get on the loan?
We locked in literally the day that the rates went up at 5.08%, 10 years, 3 years IO, 30-year AM.
What I was going to ask. So that's great.
Yeah.
Do you have a step down or yield maintenance or?
We do have yield maintenance.
Okay. And I don't think that this is a possibility with that loan package, with the small balance loan, but do they allow assumptions?
I believe they do allow assumptions. Yes.
The only problem I always see with the assumptions that is what's your projected hold period on this one?
So this one's a little bit unique too.
Okay.
Typically we like to go in and value add and be out in a couple of years. And because of who we ended up partnering with, we ended up taking this down with just myself and two partners. So we thought we were going to syndicate it and go out and raise a bunch of money. We needed about $2 million down between the down payment and the Capex that we were going to put into the interior units. But between the three of us, because it's local to each of the three investors, about 30 minutes from where each of us are, and we have so much confidence and excitement about the asset itself and the area that we're in, we are looking at this as a 10-year hold.
Okay.
Things can change. We may, want to refi or whatnot, but giving the yield maintenance and given the asset itself, I think we're going to hold this one for 10 years.
Okay. That was going to be one of the things I was going to ask about too, because when you do a larger syndication or not a larger one, this is a great one to syndicate if you needed to do that.
Mm-hmm.
This one, whenever you're syndicating and you're projecting that 5 to 7 years, you have an assumable loan, especially with, I believe, the Freddie Mac small balance loan, they allow you the new buyer to assume it, but they don't usually allow supplemental loan on top of that. So that person would have to raise the difference between the amount
Right.
balance of the loan plus the other. So there's
Right.
always that to consider in addition.
That's a good point.
The yield maintenance piece of it too.
Right.
But every lender is a little bit different, but I'm pretty sure on the Freddie Mac small balance, they don't really like that. And I don't think they actually allow that to have like supplemental or mezzanine or anything like that on top of it.
I do know you're right about that because that issue did come up. Mm-hmm.
Yeah. Did the seller have debt on the property or was it already paid off?
He did have debt on the property. And when we looked at the property and basically the loan was not assumable. So, we took that avenue first and their rates would have been, significantly higher, no IO period. So we just decided to get our own financing.
Yeah. So let's talk about Freddie Mac, small balance, CBRE. How was that process? Was it easier than you expected? Was it harder than you expected?
It was much easier than I expected. I do a lot of commercial financing on my smaller stuff. Mm-hmm. So I don't go the traditional, Freddie Mac and Fannie Mae unless I really have to. So I've worked with some small commercial banks and the process is typically fairly easy commercial. But I was surprised on this large of an asset how easy it really was for us. And, there's some reasons for that. The property was a very strong property. We knew and CBRE knew that the market rents really were significantly below what they could be and should be. They were excited to deal with it and actually kept some of the risk. But all three of us were basically the KPs as well as the sponsors and the partners, and so all of us had the assets that we needed and the liquidity that they required. And basically, once we provided all of our information, it was we're getting certain exceptions and here's your approval, and it was pretty easy.
So let's go over some of the numbers on this asset now as well. First, before I go into this, how challenging was it to underwrite this property when you have, it's kind of like a multi-use property because you have the self-storage units on it, plus you have the apartments, but some of the apartments were different kinds because you also had, the 4 duplexes and one of the triplexes on the property too. So how hard was it to try to figure out the underwriting on this?
If it wasn't that I knew this market really, really well, because I already have a lot of units in this area, it would have been much more difficult than it was for me. But because I own singles, I own duplexes, I own a lot of 4-unit buildings, I knew what the rents on those things really would be. Mm-hmm. And I knew, one of the things that we are looking to do, and we've actually already started on 2 units, is we're turning them into Airbnb short-term rentals. We're in an area where we're really close to the Hershey Med Center, which is a strong research center. They have a good children's hospital. We're very close to Hershey Park and the Giant Center and a lot of tourism. And our town basically restricts Airbnb in residential areas. So we have kind of a unique area that allows us to have some flexibility to do that and to make even more money on those units than we would if they were, the standard rental units. And if they ever restrict that and it falls back, we just go back to renting it, as another unit. But it wasn't that difficult because I know the market really well.
Mm-hmm. Had you ever underwritten self-storage before?
Just not 44 units, not that large, no.
Yeah. So when you were coming up with the valuation on this, did you have to look at different cap rates based on the income off of the self-storage plus the income off of a different cap rate based on the income off of the apartments? Or did you just kind of lump it all in one and base it off of a multifamily type of cap rate?
I basically did the latter. I looked at what are the rents going to be for everything. We have 44 storage units, so I assumed that we'd keep 4 of those for, snow blowers, large mowing equipment and whatnot, and that we'd use the other 40. And so we lumped them into our NOI number and just used the existing cap rate and felt like we were pretty confident in what the number would be.
Yeah. So just kind of classifying it as like other income, like, valet trash and stuff like that or something.
Exactly. Yeah. Along with our pet fees and our our storage fees, our laundry fees, we put all of that as other income.
Okay. So on the property here, what are some other value plays that maybe you're thinking about adding, like that valet trash or maybe laundry or anything like that? Was there anything additional? I know you said that there wasn't really a lot of deferred maintenance, but were there any things that they were not doing that you're looking forward to possibly implementing?
Sure. The one thing that we did right away is we replaced all of the toilets and all of the faucets to reduce our water costs. The water costs were pretty high and they are paid by the landlord. So we had a $21,000 Capex budget just to go in and do the water saving plan. And we just completed that. My partner has about 200 other units about half an hour away. So he's done it, numerous times. And we knew it would be about a 2 to 3 year recovery period. But it would cut our expenses at least by a third, if not more. So that was really the only big place that we had to cut expenses. The other thing, it was just a small thing, but they paid for phone, internet, and cable for the office, and all he used was the phone and the internet. And he really didn't use the landline very much because he had a cell phone and everything rolled to it. So they were paying, $250 a month for phone and internet and cable, and they really only needed to pay about $50 a month for that. So we cut that right away. We went to a Google Voice number that's routed to a cell phone. We got rid of the landline because it's really not needed where we are. So those were really the only 2 things we had to do to cut costs. Most of our value play was in the fact that the rents were about $195 a month below market. They had not been raised at all on many tenants for several years. And the seller was close to retirement. They liked their tenants. They liked getting their check. His attitude was, well, every other dollar I make goes to the government anyway, so I'm not raising the rents. So it was a really good thing for me. And, I paid more than its current NOI, based upon the value, but I knew that I had so much room to raise those rents. So what we did is immediately we went in and gave our tenants 60 of the 73 units were on month-to-month leases. So we were able to very quickly go in and say, okay, here's what we're going to do. So I knew that at $800 a month for a 2 unit, they should be at $975 to $995, depending on, the interiors of the complex. So I said, listen, if we just raise their rent $75 per month, give them 60 days notice, at $75 per month, we met our year 1 income goal without doing anything to the interiors. And even at that increase, they couldn't have afforded to go to a 1-bedroom apartment next door and get anywhere near, what they were going to pay at a $75 increase. So we increased everybody $75. We got maybe 5 people that want to move. And for those that are moving, we're updating the floors, the flooring to nice hard vinyl plank. We're painting the interiors. A couple of them need appliances, and we'll be able to get the $995 easily at that point.
Wow. Well, that's definitely pretty significant. I've seen like 50-60% of a property, being all month to month, but almost 100% of them in that situation would be month to month. So
right.
Definitely. Now, when you increased it to $75, did you get them to sign a year lease from at that point, or did you just continue to keep them on month to month?
I'm keeping them mostly on month to month because we want the ability to raise rents. And if they move out, it's great for us because we can go in and raise them. Just an example, one person that did move out, all the walls were very antique white, very vanilla, standard carpet, older cabinets. We went in and just painted a nice repose gray. and put in new flooring. Didn't spend more than about $2,500. And I got 975 and about 90 people in 2 weeks that wanted to see that apartment. So, and we knew this going in. I mean, we were so excited about this deal because it just seemed too easy. But those are the kind of deals that you want. You don't always find them, but it really is a great asset that's not a significant amount of work in order to force the appreciation.
And this deal found you instead of you finding it.
Yeah, it really did. I wish they were all this way.
So what was the actual NOI on this property when you were doing the underwriting on it?
Oh goodness, you're going to ask me that. Let me look and I'll tell you here real quick.
You said the hold period on this one was 10 years. So the 10-year projection. And what about the entry and the exit cap?
Okay. So we ended up the starting NOI. I mean, it was initially really low. But we ended up buying it at about a 6.5 cap based on its current operations. And I did model it, fairly conservatively, I feel like, at a sell of a 7 cap, assuming that the cap rates are going to, increase over time. But our rents and our NOI will obviously be much higher at that point.
Mm-hmm. So at the entry cap rate of 6.5 at a 6.2 million purchase. My keyboard will work here.
I'm just trying to find my year one. I'm sorry.
Oh, that's all right. Let's see. I did it the wrong way. Let's see.
Our NOI was under 400,000.
I got like 403, so
yeah, right about there.
It's like right under 400.
Yeah, right under 400. I mean, so, some of the, for example, like the laundry income, the father took the coins every week. So they had no idea how much their laundry income was. They said it was a lot, but those kind of numbers, you really don't know. So we didn't include, any of those numbers.
Quantify it when they say we make a lot off of it.
Exactly. Yeah. And really what we planned on is, by the end of year one, our NOI would be 472,000. By the end of year two, 527. And by the end of year three, 545. And that's really just painting new floors and bumping all 60 of those units up to market rent. But we've already exceeded our year one numbers just with a $75 increase in the few that we've updated.
What was the projected cash on cash?
The projected cash on cash. Now, one thing to know is that, as we said, we had 3 partners and one partner put in $2 million. And the capital contribution is a little bit lumpy. So we have some money going in, at closing, other money he's giving us, to do more Capex in the middle of year one. And we've got additional money being dumped in 2 and 3 to pay for deferred acquisition fees.
It's kind of hard to calculate that.
It is kind of hard. So we used our spreadsheet. I used Michael Blanc software and went in and made those changes manually to kind of figure out where we are. But part of the reason for the lumpiness when I tell you about our cash on cash is because it wasn't a one-time dump of money and then, it's consistent. So basically the first year we're projecting a cash on cash of 8.2, year 2, 9.49, and then it goes up from there. So his average cash on cash return over 10 years is about 9.42.
9.2?
9.42.
9.42. Okay.
Yeah.
That's over the 10-year hold.
Correct.
Okay. What was the projected IRR?
Projected IRR at a 7 cap exit was 14%.
And that's and an IRR is expected, as you hold on to something for a longer period, like 10 years, is expected to kind of, be lower like that. But I think even with the amount of the ability to be able to increase it the way you're going to be able to increase it, I think that's actually not a bad deal at all.
Right.
The other thing that I would point out here, and maybe you've thought of this, but I get questions all the time about why do a lot of people only hold a property for 5 years, and especially some of these larger complexes. And one of the main reasons why is because of the taxes. So when you have an outside engineer firm come in, they do cost segregation analysis, they are able to accelerate the depreciation schedule from just that 27.5-year period to either 5 to 15 years.
Right.
And so a lot of it's front loaded on those first 5 years. And so those first 5 years, most of the time, maybe not most of the time, a lot of the time, you can have income coming off the property, but showing a loss due to that accelerated depreciation from the cost study. But then once you get past 5 years, you sometimes start to show a profit because the depreciation doesn't outweigh the actual income on the property. And so that's another kind of balancing act that is a consideration as well. And I know a lot of people are always curious about, well, why is it always 5 years? 2 reasons. One is the taxes. And the second is also that IRR number. Because the longer you hold on to somebody's initial capital, the lower that IRR is going to occur.
Right. And the one thing just to point out too is, our spreadsheet didn't model the tax benefit into that return at all. Yeah. But our investor was going to have some very large capital gains this year. So we did do a cost segregation study, and we will have a little more than $1.5 million bonus depreciation for 2018. So that was another really sweet, piece of the puzzle that's not always shown in these IRR numbers.
Yeah. Yeah, I totally agree. We usually always try to do a top tier tax bracket cost seg analysis on what that would do from an IRR standpoint. And it usually jumps about double, sometimes more than that. It can go even more. Like this is 14, it could be 28% when you start to calculate in the advantages from the tax side of things as well.
Right. And it was great because I did sell some properties this year. So I had some capital gains that I was going to have to pay, and it will be completely offset with the bonus depreciation.
Yeah, that's great. So how did you structure it with the investors? So it was yourself, this gentleman that brought in around $2 million or right at $2 million, and then you had one other investor. How did you structure it with everybody?
Sure. So there was a lot of back and forth negotiation with this. I went in obviously thinking that I was going to, get certain compensation that I wanted, a certain percentage of ownership and cash flow and whatnot. And when you're working with 2 different investors, we all had something different that was most important to us. So we had a lot of back and forth before we finally said, okay, here's something that we're all comfortable with. And so what we did is the gentleman that I first approached that I'm partnering with on several deals, his name is Rob Neidlinger. He owns a flipping business, a rental realty business, and then also has about 200 units. But he's about 45 minutes away from this complex. So he is not as excited about doing the asset management day to day in terms of managing the property manager, being on site when things go wrong. So I'm kind of taking that part of the asset management role. And then he has a staff who does property management, who already has all of the financial stuff in place to basically handle the financial reports and all of that. So the 2 of us are sharing asset management responsibilities. We split an acquisition fee a little more than 3% upfront that's being paid out over 3 years. And then we have a 2% asset management fee that we split. And then the monthly cash flow goes 75% to our investor who has the $2 million in. And then the other 25% is split between the 2 of us.
So you didn't have to bring any capital to the table. He brought all the capital, and you're bringing all the legwork, if you will, and the
absolutely
deal and putting everything together. That's a phenomenal. Now, I haven't heard of an acquisition fee paid out over 3 years, but I'm sure that was probably just negotiated in the beginning, and
Yeah, I mean, obviously we wanted it up front, but there were some, the numbers changed, the LTV changed throughout the process. We dropped the single family house that we thought we would have. And then the, amount of money that was coming changed. And so the, primary investor needed to just be wise with when he injected the money. And so we just figured out what worked for everybody and came to an agreement.
Okay. And so that acquisition fee is split between you and then the other person that's helping with the management too from the financial side?
Correct.
Okay. And then what did you say the asset management fee was?
The asset management fee is 2%.
Okay. So both of those very, very well in line. Is there any disposition fee?
No.
Okay. No refinance fee if that occurs or anything like
Correct.
that? Okay.
Right.
And so,
and part of that is because we felt like since he was bringing all of the capital, we didn't put capital in, even though we're doing a lot of, the work up front, the underwriting, the asset management. It just, if we had our own capital in, we probably would have asked for a disposition fee as well.
mm-hmm. Now the 25%, is that also split between you and this other person?
Yes.
Okay.
That's right.
Is that split just a straight 50-50, or how does that split occur?
That split straight 50-50.
Okay. All right.
And then ownership itself, the partner who has the $2 million in is a 51% owner of the company and the property. And then my other partner and I split, we're each 24.5% owners.
Okay. All right. That makes sense. Well, let me see. Trying to digest those just a little bit.
We got kind of creative here.
Yeah, that was definitely creative. You caught me off guard with some of that stuff. So, from a occupancy standpoint, what was the physical occupancy, and then what was the economic occupancy on this particular asset?
So the physical occupancy was pretty high. When your rents are, $150, $200 below market, people don't move.
Stay pretty full.
We had one vacancy, during the purchase process, and we had them leave that one unit vacant, and we updated it right away, and got the higher rent. So economic occupancy, they really didn't have rent concessions. They just had super low rents.
Yeah.
So it was difficult to come up with an exact number because it wasn't like they were
paying.
Everybody was paying, yes.
Okay.
And again, part of that comes back to where we are and the fact that it is such a nice area. You've got mostly people who are employed, who make good, above average incomes, have decent credit. And so we don't get a whole lot of the, issues that we have in some of the C and D markets.
Mm-hmm. And what was the Capex on this? I know you had mentioned a few things here and there, but what was the overall Capex budget on this one?
So this one, again, is kind of stair-stepped in the way that we ended up doing the payouts because of where his money was coming from and when he was going to have it versus when we settled. But we had $97,000 set aside, at closing for interior improvements, and a total of $200,000 that would be paid out over 2 years. And that included us updating the 2 units that were making Airbnbs, as well as the water saving plan. And then the rest is really for money for painting and updating the flooring in the units that we need to.
Okay. All right. So I have a couple of kind of final questions I want to ask you about this particular property, because it sounds like a phenomenal deal. I wish you would have asked me about it, but
the next one maybe.
Well, what did you expect to be maybe a little bit harder, but ended up being fairly easy throughout this process?
I think the lending, the process with CBRE was really amazing. They were very good at telling us up front, here's where we might have issues with the underwriting, and got the waivers for the things that we needed. One of the issues that we had was that because they base everything on currents, and we knew, currents were not in line with where they needed to be, we got a little bit less LTV than what we really wanted. But other than that, we still ended up at like 74.9% LTV or something like that. But the process was pretty seamless and a lot easier than I thought it would be.
And then the opposite of that, what did you find that you thought might have been pretty easy to do, but it ended up being a little bit harder?
I think probably just all of the negotiations that were ongoing. So anytime you're working with partners where, as I mentioned before, most everything that I had in my portfolio, I had bought by myself or with one other person. So once you open up to multiple partners who are really GPs of the deal, there's just a lot of different priorities and different needs and different wants. And so working through all of the legal documents, the operating memorandum, the operating agreement, roles of partners, what you're going to do if somebody dies or somebody wants out. We all had our own attorneys and our different ways of doing things. And so just getting through that process, it wasn't that it was difficult or uncomfortable. It's just, it was a lot of legwork and a lot of things we had to be doing at the same time that we're, trying to do our due diligence and trying to handle the lending and figuring out what we were going to do with the asset when we were done with it. So it just took a lot more time than I thought it would.
And last question here is there anything that you would do differently on this deal if you had to go back and do it all over again?
At this point, I don't think so. I think it went pretty well. I mean, you always learn a little more about each other. If anything, I think just really getting to know the people that you're going to partner with. I knew one of my partners fairly well, and the other one I did not, but respected him. He's been a broker and in real estate for many, many years. But there's sometimes when because you have different personalities and you don't know each other well, you might end up butting heads on some things that are really just a difference of personality and having to learn how the other person works and what they want and what they need. So I think where sometimes I just made assumptions that, hey, my partners will be fine with this, I'm going to work this out with the seller. I learned that I really should have said, hey, this seems small, but I want to run it by you before I go and negotiate something. So just making sure that everybody's talking about everything throughout the entire process.
Yeah. Well, Anna, I want to thank you for taking the time to be with us here today, sharing all this information. It's a very unique property. Seems like it's going to do really well for you. How can the listeners reach out to you if they have further questions about this particular project, the Brownstone Manor apartments, or if they want to maybe reach out to you and maybe, get involved with some of the other projects that you might be putting together?
Sure. So I have two websites you can go to. One is www.reimom.com, where I talk about real estate. I do some mentoring and some coaching for people just getting into small multifamily projects and small single family. And then I also have a website that's Zenith Capital Investments, where we are starting to syndicate and buy some other larger assets where we will be raising money and syndicating if you're interested in any of those deals.
Awesome. Well, again, thank you so much, Anna, for being with us. Looking forward to continuing to follow you and looking forward to having you on a future episode as you close your next deal.
Thank you so much, Dan. It's been my pleasure. I really appreciate you having me on.
You as well. Hope you have a good night or have a good rest of your day.
You too.